Okay, welcome everybody to the monthly Preferred CFO webinar. Today's webinar is entitled How CEOs Can Unlock a CFO Mindset for Themselves and Their Controllers. We have a very distinguished guest panelist today, Brad Siler, who's a seasoned executive and a financial strategist with over 20 years of experience of guiding companies through transformation, growth, and global expansion. He was named one of the top 10 inspiring CFOs in 2023 and has built a reputation for operational excellence, disciplined financial leadership, and strategic innovation. Brad, welcome and show us how to unlock the CFO mindset.
I appreciate it. Well, first off, can you guys hear me okay?
We can hear and see you fine.
Okay. Uh, Sorry for the delay. Everyone had little technical difficulty issues. Must be a Monday. Anyways, well, thanks for the introduction. Appreciate it, everybody. Yeah, appreciate it, Bob. So, you know, um, yeah, it's an interesting thing. Let me go ahead and share my screen as I kick this off here, so I can hopefully do that appropriately. Share that. Hopefully, everyone should see the preferred
Actually,
CFO.
just to interrupt just for a second here, one point of housekeeping. If you do have a question, we'll handle that through either the Q&A or the chat. You can just type in the questions that you have. We'll hold those to the end, and then we'll field the questions. That way we won't interrupt the presentation. So if you do have a question, you can access that either through the chat by typing it in or the Q&A icon on the bottom. Okay, thank you, Brad.
Sure. And thanks, Bob. I assume you'll be monitoring those, or may I ask if you're
We
monitoring
will
those?
be monitoring those as
Okay.
we go along.
Once I get rolling, things just roll. Um, so yeah, just alert. I'll try and monitor that well if you see a hand raised or something like that. So, well then, thanks everyone for joining. Yeah, the title of this is, how CEOs can unlock a CFO mindset. This is an interesting title. And the content, there's kind of two objectives, which I'll get into in here in this presentation, but in the end, let's just keep this very simple. This isn't overly complicated. Um, Pretty simple techniques. I believe most of you are doing some core functions of these anyway, as you see when we go through some of this. But when it's all said and done, when the presentation's over with and you're ready to walk home, go done for the evening, what I'd like you to take out of it is ask questions. I mean, that is truly the simplest way to do things. Ask questions of what does this mean? How does this work? Please define this for me. Always be willing to just ask questions. That is the best way. That's the best advice I have when we come out of this presentation or anything. Because if you ask questions, that's the CFO mindset. Because we always ask questions. If you have consultants that come into your business, if you have advisors come into your business, what do? They always ask questions. So the mindset in general is ask questions, because the more you know, the more you understand, then the better you can apply that to the business. So that's the underlying, I guess, objective. Take that away when you come away from this. So you'll see on there's my number, so you can see that. You can contact me if you need to, phone, text, email. I'll answer it. They have over 30 years experience with very large corporations, small startup type companies, mid-sized corporations in multiple industries. But in the end, it still comes back to the same concepts that we're going to cover here today. So let's go ahead and just jump in. So you'll see a couple of different things as I go through the slides here. I'm a big person when it comes to finding meaning, leadership concepts, philosophy, strategy. So you're going to see something on every slide. Just to give everyone a heads up, it's Ted Lasso. Love that show. There are a lot of great meanings, a lot of great sayings and mottos and quotes in there that you can just take meaning out of. So you're going to see that on there, and I speak to it because just kind of how I go through things here. So, the executive summary to start with is that box down here. In today's volatile business environment, CEOs, you need more than just vision. Need more than just operational activities or business development. You really do need a financial fluency or literature or discussion or terms. This presentation will explore how you can kind of adopt some of that CFO mindset in those terms to really help you make stronger, more resilient decisions going forward. And so if you look at the very top, what is a CEO mindset? And you could Google it with AI. You can go through, the Chat GPT or Copilot. But in the end, I look at it as a CFO mindset, CEO mindset is strategic direction. You look at your growth, you look at value creation, execution, culture, but not a whole lot of financial stuff in there. A CFO mindset really takes everything above in that top part and try to go, okay, how do we get clarity on some of that from a financial rigor, a cash management perspective, an overall financial strategy per se. So it's really blending the two, and that's what the objective of this is how do we teach you to kind of tweak your mindset to really think both as a CEO, do not lose the skill set, do not lose who you are and what you've done to create the entity in the organization you're either you've created or you're running today. So we want to combine that with some of these financial aspects that a CFO thinks about. That's objective number one. Objective number two is how can you evaluate if your controller has the ability to become a CFO? So it's kind of two different perspectives or two different objectives in this presentation, and I'll be going back and forth, and hopefully the presentation you'll see it try to put it as clear as I could there. But it's really two. One is for yourself as a CEO to incorporate that mindset into your own thinking. But then also one of the key things is you need to have a trusted partner. You need to have that CFO that you can trust. And the question is, if you do not have a CFO, does your controller have the ability to become that CFO? And this will kind of give you little tricks and questions and techniques that you can do to kind of make that evaluation. So in the end, the bottom line now you'll see that from Mr. Ted Lasso is, I believe in belief. I think you should always, he believes in hope, he believes in belief. I believe that anything can be done if you truly set your mind to it. Maybe difficult, maybe challenging at times, but I just believe and believe just like Ted does. So next one. So why? Why would I be talking about the benefits of a CFO mindset? So the benefits in general is combining a CEO mindset with the CFO mindset enables you to become kind of a stronger leader where you can balance bold strategic business decisions with that of financial discipline and controls. And the combination of that really will help you ensure success and sustainability. Now, that's all the little paragraph and the words here, but what does it mean? At the top there, you see smarter capital allocation. So if you have limited funds, where do you invest it? Do you invest it in areas that have high growth, high profit, low risk, or do you put it in areas that are high risk with low margin? So giving a CFO mindset or obtaining that mindset will help you make better and smarter capital allocation and investment decisions. Stronger investor confidence. If an investor was going to invest in your business and they see that you're not just an operational and business development individual, but you also ask those financial type questions, they will have more faith and more belief in your ability to succeed. Improve cash flows. We're going to talk a lot about cash. I'll talk about cash and profit, but if you do capital allocation, smarter confidence, you will improve your cash flows, and cash truly is the king when it comes down to running a business. You got to make sure you have the cash. Resilience during downturns. I think every company or most organizations in the past year or two have seen some fluctuation in their business, increases or decreases in volume, suppliers, customers. And by having this mindset, you start looking more forward. You start looking more of what are the impacts? What's the risk of these type of decisions you're making? So that make you and your organization more resilient to downturns going forward. And in the end, that creates more long-term value creation for the organization and your investors and your ownership group. And then what you see on the right-hand side there, I have this little box that talks about controller application, meaning how does this now apply to your controller? And this, to me, it's like if you train and you coach your controller by doing the same type of skill set that you're going to be going through as well as a CEO, if you can train your controller to do the same thing, you're going to get a much stronger ROI than going out and hiring an external CFO into your business. I've always believed in growing individuals because they know your business, they know your model, they know how you think. And if you can grow from within, you typically get a much better return on your investment, a little less costly, and then for you get that employer loyalty as well. So those are the overarching benefits of the whole thing about a CFO mindset. We do, when it's all said and done, We know accountants and financial people think a little differently, so don't worry about it. You're not going to be brainwashed through this whole thing, become a CFO. It's just adding some abilities from a financial perspective to what you already possess, which is that CEO mindset. And the combination is where you really find liquid gold when it's all said and done. Um, and then the wonderful quote from Mr. Lasso, I think things come into our lives to help us get from one place to a better one. Um, and that's what this is. This is hopefully enabling you to get from your current role and get to a better one by being able to incorporate some of the financial thoughts and mechanisms in this. So we're all on to the next one. So let's start with just kind of set the ground level. What does your daily life look like? And so when I look at it here, let's be realistic, always run simple. When you come in every day, you focus on the emergencies, you focus on the crisis, you have to do problem solving. You look at sales growth, you look at your customer satisfaction, you look at your products and services maybe and say, okay, is there something we're missing? Operational challenges, you may have some of those, or then maybe a supplier or some constraints or cost increases. You may be worried about the culture and the employees. That's the daily life. We're all busy day to day with what we're currently doing. But if you look at that, most of that does not incorporate a financial discipline or financial strategy. And it's not about replacing any of those items up above. It's integrating them and ingraining them together. Any emergency will have a financial component to it, a crisis, a problem solving. Sales growth certainly has a financial aspect to it. So I just saw there's a chat coming along there. If I need to do something, Bob, just let me know. So really I understand your daily life is busy, you're swamped, you got 30 things pulling you 30 different ways. So not trying to add one to your list, it's more of ingraining it so that it's just an automatic thought of, if I'm going to go down and problem solve this issue, you now ask another question or two that you may not have otherwise. So it's ingraining this financial mindset. And then down below, and this is the scary part about it, taking on a challenge is a lot like riding a horse. Yeah. If you're comfortable while you're doing it, then you're probably doing it wrong, which means this is going to be uncomfortable for you. It's going to be different. It's going to be a learning process for you, but that's not a bad thing. It's a good thing. Because you need to just learn and get a little uncomfortable because you're going to challenge yourself to learn something new. So understand that's a CEO's daily life. Now, let's talk real quick and let's switch gears and look at the controller. And I know one of the questions many people have when they come down to is, what's the difference between a controller and a CFO? Well, let's just cover that real quick. And again, keep it simple. The simplistic way that I look at it and I define it is a controller tells you what happened or they're past looking. A CFO tells you what will happen or they're looking in the future. So that's the cleanest, the simplest way that I can kind of deviate between the two or separate the two is your controller is very factual. It's very data-based. It's very structured. A CFO uses all that information, but they're more forward-looking. They might do more analysis. They do more projections. They do more forecasts. So you look at this top line, primary focus, controller, they're focused on the accounting accuracy. Make sure the entries are made correctly. We're compliant with GAAP, financial results, all those wonderful things. But a CFO, they use the financials to do planning. They do forecasting. So they use what's the result of the fact-based individual, the controller, and then they change that to say what's the future looking, the planning and the forecasting. Core responsibility of a controller is bookkeeping, audits, financial reporting. Again, factual, what happened and what's in the past. Your CFO uses all that financial information and reports and stuff to do what's the best use of our capital, what's the best use of our cash, how do we forecast it? Let's manage our relationship with our investors, with our lenders that may be out there. So it's all about forward looking versus just what happened. It's using the data and then thinking differently of take that next step. Ask that question, what if? Which is a question that I would throw out there. Decision making, controllers, their decisions are focused on accounting and reporting. Did I book the entry correctly? Is revenue recorded appropriately? Did I record payroll correctly? Whatever it may be. CFOs, they make the high decisions based on risks and ROI, saying, okay, if we're going to go down this avenue, we're going to try a new initiative. What are the risks? Is it low risk, high risk? What risk is it? What's the ROI on something? For example, you have something that's extremely high risk, we have a very low return on investment, then most likely a CFO would say that might not be the best use of our capital. We may want to put our investment into an area that's low risk, high returns, or high ROI. That's again the analysis the CFO does, the change in the mindset. Then there's team leadership. One leads accounting, the CFO leads finance, accounting, tax, treasury, risk management, a more overarching view, which you'll see is very strategic as we get down into it. So in the end, that's the difference between a controller and a CFO. And to keep it simple, controller is factual, what happened in the past. A CFO is, what will happen, kind of future looking through that whole process. And I love this quote a lot there, because I do love a locker room. It smells like potential. Because I believe everyone has the potential to learn. I've always believed that people come to the office to try and do their best, and they want to grow and they want to succeed. So most likely you have a controller that in their mind, they want to grow, they want to succeed. And somehow, how do you unlock their potential to achieve that? So just love that phrase there. All right, there's our baseline. What CEOs look at every single day. What's a controller and a CFO? What's kind of their daily life? So let's ask the question, what is a CFO mindset? Again, don't overcomplicate it. I know sometimes financial people can think differently, but keep it simple. The CFO mindset is about thinking in terms of value, risk, and return. It's about maximizing the impact of the dollar that we receive or the dollar that we spend. And yeah, CFOs are okay spending money, but you just want to make sure you get the value for that spend. CFOs are stewards of your capital, they're experts in forecasting, and they're kind of guardians of your long-term value. Simplistic type view and answer there. So what does that mean, kind of nuts and bolts, if you go up to the top here? Value-focused decision making. There's lots of scenarios and examples I'll give throughout this this presentation, but the value-focused decision making is you may have a great idea, great initiative in an organization, but in the end, if all that is going to do is cost you a ton of money, and when it's all said, the value you get from it only decreases the long-term value of the organization, then is that a decision worth making? Or is there one that says, okay, where can we invest our money that has a more promising or more risk-averse long-term future value growth? And I say that, but I also want to make sure I balance that out. There are times when you do invest money knowing that you're not going to get the return you want on it, because there's other things of non-financial returns that organizations have and benefits the organizations. Company culture is one. Sometimes you invest a lot of money in employees and decisions to enhance employee experience. And yeah, it's going to cost you money. You may not drive more value from a customer, but you know what? You're going to get an incredible culture. And that's why you see organizations being rated as what companies have the best culture that typically people want to work for. That allows you to get the best talent. That allows you to get more return from the work that you're getting from them. So there could be some longer term value, but just saying that there's a value focused decision making. Just don't make a decision without looking at kind of all the facts associated with it. Forecasting future impact. Certainly that's something that a CFO says is, if we make this decision, what does it mean? And I'm going to come back to that in a second here. But ROI driven resource allocation, this is where you blend risk and you blend the value, what's going to be the return on it. And if you know that, it's not saying you only do one or the other, but at least you can make an educated decision on what you're going down. And then you can expect, you can anticipate something, you can anticipate what the results might be. Financial discipline, a simple example of that is if you have options in front of you, you want to take the one that has the lowest risk and the highest value return. And a simple example of that is you can have two banks that don't want to lend you money, but in the end, if one bank is going to charge a 10% interest rate, and the other's going to charge you 14% interest rate, but yet it's the same value or you get the same benefits. The discipline says I may have liked the guy with, the banker from the 14% interest rate bank, but man, I'm only getting charged 10% from this other bank. So have the discipline to use financial metrics to make decisions. It's what's best for the organization for the most of the times. Risk management, we won't get into that much here, but it is a component because every decision in a business has risk. It's all about measuring how much risk and how much are you willing to absorb. So, yeah. For example, if you want to go out and hire a new salesperson, that's going to be a risk because you're not sure if that new salesperson is truly going to value or bring in the value of new customers. It may take 12 months, it may take 18 months. What's the sales cycle in your organization? So that is a risk, but it could be the right risk to make because your current salespeople are tapped out. They don't have any additional time to do more business development. So every decision has a risk. It's about understanding that risk and understanding the financial components of it and do the what if scenario of what if it's a good decision? There's your positive thinking. What if it doesn't work out? What's my downside? What's my cost? And again, not that you shouldn't do it, but you should be aware of what that downside could look like. So risk management is something a CFO always looks like. They always think in terms of risk. And then the last one, which I'll talk about, is cash is king. I know there's a lot of belief out there, again, there about people, what's the profit of my organization? What's my EBIT of my organization? But cash really drives a company. So the quick analysis I would show here is, I'm assuming most of you or many of you have seen the movie Field of Dreams. So Field of Dreams, incredible movie, incredible partial true story, but the individual, plowed out a majority part of his land, took out all the corn, and built a baseball field. Well, he did it for certainly non-financial reasons because there was other things driving his decision. But think about the what if. Think about the other side of it. And this, I'm not, I love the movie, so I'm not downgrading the movie, but what you're seeing is he spent all of his cash reserves on building a baseball field. That doesn't bring in any new cash. Now, his crops would bring in cash when they sell, but you got to wait 6 months, 8 months, whatever the time frame is for those to grow and sell. So he took his cash, spent all of his reserve cash to build a baseball field, and what happened? His crops weren't ready to sell yet, and he didn't have cash to pay his mortgage. Now, at some point in time, when you sell his crops, he's going to make a profit, and then he'll have more cash, but it's a timing issue. And that's the biggest thing I want to get to in cash, and I'll talk about it more in a minute here. But understanding cash versus profit, because they are two different things. So we'll get to that more in a second here in the control application. This is something that I think it's a matter of how you listen to your controller. If you think about trying to grow your controller into a CFO, has your controller exhibited the ability to make decisions? Or have they ever asked, what if, or how are we going to pay for it? If they're just giving you the financial statement and say, okay, here's your financials, yeah, okay, go with them, have fun. They're stopping at the past. They're stopping and just reporting. Now, have they say, here's your financials. I know you want to, add another salesperson. How are we going to pay for that salesperson based on our payroll already being 20% of our revenue, whatever it may be? So the question is to think about as you interact with your controller to see, do they have the skill set to be a CFO? Are they asking the questions of what if, how will we pay for it? Are they asking future-based questions? So some of you just to listen more to your controller and just see how they interact with you. And then the last line, there's a major story. If you watch it online, it's a great one. But the Ted Lasso says, the underlying comment is be curious, not judgmental. Ask questions. Just like I said, begin the presentation, ask questions. It's the best thing you can do. So let's get back to the let's flip to the next page here. Yeah. So I talked about profit versus cash flow. And so again, try to keep it as simple as I can. Cash flow is the cash that flows in and out of your business. Doesn't mean you're profitable. Doesn't mean you're not profitable. It just says how much cash is coming in versus how much cash is going out. Profit is what remains from your sales after all the costs to provide your goods or services are deducted. So that tells you if you're profitable. Now, you may not realize all that cash for 6 months or 9 months. You may not pay all your expenses. You may not collect all the money from your customers for timing issues. So the two are completely different from the standpoint of cash runs your business on a day-to-day basis. Profit tells you when it's all said and done, when all the tickets are, collected and all the money is collected and all the bills are paid, did you make money? That's the long-term value growth of an organization. So profit will show the overall success of your business, but cash flow keeps your business alive until you can realize that profit because the timing is different. Best example I can give you in this one. You have suppliers. Let's just say you purchase raw materials for manufacturing, you buy some product, and you turn around and you sell them. So you have your accounts payable, you need to pay your suppliers, and you have your collections from your customers. That's your accounts receivable. So if you're paying your providers in 15 days, but you're only collecting from your customers in 60 days, you have a negative cash flow cycle of 45 days. So every sale you make, you have to find a way to find the cash for 45 days until you collect it from your customer. Now, when you finally collect it from your customer, you may show a 20, 30, 40% profit. That's awesome. But how'd you survive 45 days without cash? So this is where cash is timing. Cash is critical to watch. And while the ultimate goal is profit, while profit is the ultimate goal, cash flow is the lifeblood of the organization. So you can realize that profit that you're going to have. Whenever I look at companies and organizations, I always look at what's my average time to pay my suppliers or my professional advisors or my consultants versus what's my average days to collect from my customer. If you're not collecting cash faster than you're paying it out, you're in a negative cycle and you're going to burn through cash. So it's always important to understand your cash flow. And cash flow has to be monitored daily. You have to see what's my inflows and what's my outflows. I would monitor it daily, maybe weekly, but you monitor it daily because in the end, if you know you're getting more cash in than you are getting cash out, when it's all said and done, you're going to be profitable and you're going to have your long-term value creation. So to me, it's understand the difference between cash flow and profit, especially for small growing businesses. Cash flow is it's almost more important than profit because most likely you're going to have to pay your payroll every 2 weeks. You're going to have to pay your rent every month. So if you're not collecting money from your sales and from your providers faster than every 2 weeks or every month, you're going to have a negative cash flow cycle. Keep it simple. Think about your home, right? Your mortgage is due once a month. Your utilities are due once a month. Your allowance for your kids, if you have kids, is due once a month, maybe sooner. So if you have to pay all this money out, when's the cash coming in? You can't wait till the end of the month to get cash in because now you're negative. So you need cash at the front end so you can pay your mortgage, you can pay your utilities. Business is no different. It's just like running a household. I need cash in before I pay cash out. At the end of the month, I have more cash, so life's good. And that's my profit. So change the mindset from your business to think more cash related than profit. Because in the end, if you get more cash than you're paying out, you're profitable. Keep it simple. And then applying it to your controller, I would ask question, does your controller talk about cash flow or profit first? If your controller comes in and says, hey, we made X amount, X thousands of profit this month, that's awesome. Your ask questions would be, what our cash do this month? Did our cash increase or did our cash decrease? Your controller, if he starts thinking more like a CFO, will start thinking more cash oriented than profit oriented on that standpoint. And then the quote there, I love saying, I know you can read it, but I just love to say them. That to say youth is wasted on the young. Well, I say, don't let the wisdom of age be wasted on you. You're a CEO. You've run your business. You've been involved in business. You've been involved in activities. You've been successful to become a CEO. So you've had some success. use your past knowledge of how do I make sure I manage my personal finances? How do I make sure I manage all this other stuff? Use the experience in the past to apply it to this situation. So don't let that experience be wasted as well. The wisdom of your age. So, all right, we'll keep rolling on here. So some just very simple or very just, you know, tangible items you can grab on. Um, the core pillars of your CFO mindset. First thing for you to think about is your financial literacy. Understand the balance sheet, understand the cash flow, understand the income statement. And you see, I put that in a specific order on purpose. Your balance sheet, understanding your cash, your accounts receivable, and your accounts payable, vital, vital. Because that's going to lead you to your cash flow process. I know what your cash flow is going to be. So understand your balance sheet, understand your cash flows, and then understand your income statement. Okay, that's where you get to that. And the income statement has a lot of non-cash items in it, but we're not going to go to that level at this point because that gets a little more confusing. So grab the balance sheet, the cash flow, and learn it and learn those items. Ask the questions. Ask your controller. Hey, controller, what is this line item cash? What is this line item marketable securities? What's this line item as accounts receivable or accounts receivable reserves? Ask the questions. Cash flow, we just talked about it. Growth and profit is great, but cash is king. You got to have the cash to survive. And just an example of a company I was associated with, I worked with that they were a trucking company, and excuse me, they decided to take advantage of some certain tax breaks, which made sense from a long-term perspective. And they went out and purchased, let's just say, 20 new trucks. Their recommendation, CEO wanted to pay cash for it. So at that point, you're paying cash for 20 new trucks that were an extremely expensive asset that you're buying, but those trucks were not going to generate enough revenue each month to pay for it. They don't get their kind of ROI or their payback period is more like 2 years. So we took a big chunk of cash out of reserves, paid for all these trucks out of cash, and you're not going to get the cash coming in related to the expenditure for the next, you'll get it monthly, but not over the next 2 years. So then obviously when payroll came in, when rents came in, he had very little cash to make those payrolls. So the decision to acquire the equipment wasn't a bad decision. The method of acquiring it is what caused the problem because they drained his cash to do that. So cash is king. Just keep that in mind. Always ask, how am I going to pay for it? Where's my cash? Risk management scenarios, risk management thought process, anticipate scenarios. Again, think of Field of Dreams. If he thought about it, and yeah, emotional movie, great movie, but he had a great, real story, plowed out a big portion of his field. But if he would have thought about it, he said, okay, to do this, I'm going to spend 80% of our cash reserves. How else can I do this maybe to where I don't drain our cash and get us in a situation? Maybe he should have waited 6 months till his crops are ready to actually sell, and he could have got more cash inflow to make that expenditure. So anticipate the scenarios, and the only way to do that is ask questions. And then I put on here, this is an interesting little term, inspect what you expect. And this applies to many things, that's really in the financial world. If you have a sales model when you go sell a customer, a pricing model, a sales model, whatever term you want to use, and you sell them, you say, I'm going to sell this customer on 2 products. One's at a 40% margin, one's at a 20% margin. And when you build that pricing model, you make assumptions, and this is what you're expecting. After 6 months, you should always go back and evaluate, you want to inspect what you expected to occur? Did they acquire as much of the 40% margin as a 20% margin services? If they didn't acquire any of the 40% margin, but they did all 20% margin, guess what? Your estimate or your scenario of how much money you're going to make on this customer is dramatically off because they didn't perform as you expected them to. So you always want to inspect what you expect, which means you need to anticipate what do you expect to happen when you make a decision. And that's all about risk management. It's all about evaluating what's the upside, what's the downside. And CFOs think that. That's a little more of a skill set that you can build. It's a muscle memory to get there. But if you just start asking those questions of what's the upside, what's the downside, what's my risk, then you start building that muscle that you're thinking about. ROI thinking, initiative should be measured by its risk and its return. Not every decision. If you want to go out there and buy a little desktop printer, fine, doesn't worry about that. But again, if you're going to go out and buy 20 trucks and spend all your cash, what's the risks? Well, you just spent all your cash on 20 trucks. That's not going to have enough incoming revenue to offset that cost for 2 years. What happens if the market is a downturn? What happens if you lose a customer? Now you may have 20 units or 20 trucks sitting on the lot that has no revenue generation whatsoever. Now the problem just got significantly worse. So ROI thinking is all about what's the risks. Think about the good and the downside. And it's not negative to think about the downside. You're just being practical. You're just thinking of what's the risks of this decision. And that's where I kicked it off, investor confidence. If investors know you're looking at both the upside and the downside scenarios, if they know that you've already evaluated the what ifs, they're going to have a lot more confidence in you as a CEO to lead the organization in the future. So it's all about risk and return. So think about ROI. If I'm going to spend $200,000 on this, how long is it going to take me to recoup that $200,000? If I only get $10,000 a month, then it's going to take 20 months to recoup the $20,000 or the 200,000. So think of it as far as what's my ROI, and that's where your controller can certainly help you out. Has your controller shown more concern about accurate reporting? Are my financials correct? Is the income statement correct? Versus how are we going to maximize cash, improve profitability, control risk? Have they shown that ability, or they ask those questions? Have you seen that from them? If you've seen it, that means they are already thinking about a mindset along the lines of a CFO, and then they could be groomed. And that way you can partner with your controller to do the ROI together, which again, you're going to see it in a minute here. We're going to talk about partnering with the controller. So in the end, down the bottom, a lot of times the right idea, that should be idea, is just sitting behind a couple of wrong ones. Not every idea is success. Not every item is guaranteed to be a success. And there are thoughts and there are ideas, there are initiatives that are going to fail. That's part of business. That's part of life. I think we've all gone through that in our lives. But that's okay. If you learn from it, if you go down that thing and say, here's an idea, let's look at the options, let's look at the risk, let's see what the opportunities are. And you know what? Yeah, we're okay with taking that risk. Then you go down that road. It may be successful or it may fail. It's okay, but if you've done the process in front of it, if you've done your ROI, you've done your risk management, and you've made an educated decision on what you're doing, then you're not going to be surprised at the outcome. Yeah, you may be disappointed that it didn't hit option B versus option A on the outcome, but you're not going to be surprised. And that's what key is. You want to eliminate surprises when it's all said and done. Yeah, and it may take a couple ideas to get to the right one. So, all right, I think we'll just a couple more here. Tools and practices. What tools do you have available to you? And I'm sure everyone's heard this term or heard this before. Financial dashboards. Everyone's talked about dashboards. Everyone talks about KPIs, but there's a reason they talk about them is because they're important. You need to understand your financial metrics and your working capital. So let's talk metrics real quick. The financial metrics. Speaking with an individual the other day, and they asked me kind of what do they mean by metrics, and they said, well, first thing is you need to know what your sales are doing. What's your sales growth or your sales retraction? Are your sales growing? If it's growing 5%, guess what? That's a metric. Simple. It's a simple metric, but it's a metric. Are your sales growing? So you need to have some type of sales metric. Now you can peel that back, which is what I would always do, and say, let's look at it by customer. What's every customer doing? And if you have a business that operates kind of on units or quantity, what's my quantity metric? How many more of the quantity of the units am I selling? Or how much less am I selling? What's my price per unit? Is my price per unit increasing or decreasing? So then those two combined get you to or it's called the profitability by customer. And that's a critical piece to understand. Um, so a financial metric on customer is, what is my overall profitability by customer? Um, you may have customers that are just, they're always buying your highly most margin product or service. And then you may have customers that are just buying the low ball, the window shopping type deal, the loss leaders you have going on. So you need to understand that, because when it comes down to decision making, if you got 10 customers that are doing very well and you got one customer that essentially you're barely breaking even, then the question is, what are you going to do? You need to go back and potentially to reprice it, get a new contract. You may not say to the customer, you need to find another provider. It's not a bad thing to say, because if it's costing you money in the end, it's not worth having that customer. And that's all about understanding the financial metrics. So understanding your sales metrics, your margin metrics, understand your cash flow metrics, the working capital component of this, which means, how fast am I paying my providers? Um, a company I went into were paying their bills to their providers in 10 days, but yet their terms with their customer were 45 and 60 days. So just the example I used earlier on, they're in a complete negative cash flow cycle. And so if they don't have tremendous sales that significantly outweighs their cost of their suppliers, they're in a negative cash flow, and they have to find some way to support that, 30 to 45 day timing difference, because I'm paying much more cash out the door than I'm getting in. It was my recommendation is you immediately change your terms with your suppliers and you pay them in 45 days. So that way, if I'm collecting from my customers in 45 and I'm paying my providers in 45, at least you're kind of you're holding water. You're staying your even ground. Um, so understanding your metrics, those are things as DSOs, day sales outstanding, your average payables, what's your timing on your payables. So that's where understanding your metrics and having a simple dashboard, 5 to 10 at most metrics that can be produced to you every month, almost probably once a week. Here's kind of our metrics. It's a quick look at, you can see the dashboard, you can see the 10 metrics, and you run with it. So understanding, having dashboards and understand metrics is critical. It's a great tool for you. Forecasting beyond an average budget or an annual budget. Most companies, you do a budget. Here's my budget for 2026, for next year. But you need to go beyond that. You need to start looking at cash flow. What's my cash flow? The most common window you may hear is a 13-week cash flow model. Look at my cash balance, look at my accounts receivable, look at my accounts payable, and do a 13-week cash flow projection. The thing about projections, everyone, it's guaranteed to be wrong. They will be wrong because you're projecting the future. But what you want to do is you start looking at, okay, if my cash is here, I expect this much in revenue, or let's just say this much in cash received from my sales. Here's my payments to my providers. Here's my payroll. Here's my rent. What's my net cash every week? And where am I looking at 13 weeks from now? And then next week, you update it to the next week. It's kind of a rolling cash flow projection. So do a cash flow projection model. And that's where CFOs do that. That's where your controller can help you do that. Projections, as far as once you do an annual budget, hey, you're done. Good to go. You're at the end of January, you have an annual budget, it's approved, ready to go. What happens after 4 months? Let's just say it's end of June or end of May. All right. Well, you have a difference between actual versus your budget. So now you need to reproject, what does the year look like? You may be under budget so far, but do you have a chance to recapture that? You may be over. Will you be able to sustain that overage of budget to the rest of the year? So a projection is basically just redoing your annual budget, but using a portion of the months as actual, and the remaining part of the year is your projection. So reproject yourself out. Maybe you redo projections every 3 months. You just do it every quarter just to kind of see how you're tracking against the annual budget that you put together. And then long-term plans. What's your plans for 3 years from now? It doesn't have to be monthly, but it can be more of an annual thing. 3 years from now, this is what we think is going to happen. If we're going to have sales growth of, let's just say, if you want 25% sales growth, how are you going to get it? Well, you probably need to increase your customer base, or do you increase your pricing model? That's going to start having you ask more questions of, if we're going to increase our customers, how are we going to obtain those customers? Okay, well, then we need a salesperson. All right, how many salesperson do we need? So you just keep asking questions, asking questions. My underlying theme to this whole thing. And then you ask, how are you going to pay for this? Um, every initiative you need to ask that. So there's a scenario or an example of a customer that in advance of some potential trade issues or shipping issues, they bought a year's worth of inventory now. Um, again, may have been a right objective because they wanted to avoid any shipping delays. So they acquired all this inventory right now. Well, that means they had to pay for it right now or within 30 days based on the payment terms. But yet those sales wouldn't be realized for 12 months. So the question is, how are you going to pay for that if you're using all of your cash reserves to buy a year's worth of inventory, but you're not going to collect the income or the cash from that over for the next 12 months? So always have to ask, how are we going to pay for these initiatives? And the last one there is financial reviews. Spend the time, dedicate yourself to looking at your financials, and not just amongst yourself. Look at them with your controller, look at them with your leadership team, because your leadership team needs to have an understanding of financial terms and concepts as well. You can't do it alone. You need their assistance, you need their buy-in, you need them to understand. If they're out there and they say, well, let's go ahead and do this, and they go spend this money, they need to understand what impact that has on your financials. So do your financial reviews. The controller application on this is every business has key performance metrics. Has your controller been involved with those? If he hasn't, get him involved. They should be involved in helping create, understanding, evaluating, and analyzing them. And then if they see something going wrong, has your controller propose solutions or say, hey, we need to make a change here. So last thing to say is doing the right thing is never the wrong thing. So I know people, talk about annual budgets is a lot of work. Cash flow models are a lot of work. Doing projections are a lot of work. But once you build them, they're really not a lot of work because you're maintaining them. And it's never the wrong thing, specifically in that case, because that's vital to your organization. Dedicate your time. You've dedicated your time to become a CEO of an organization. Dedicate your time to improve yourself and improve the organization by putting in these core fundamental tools, dashboards, forecasts, projections, asking how we're going to pay for these things. Build that financial discipline. Culture, behavioral skills. This one, again, as I just mentioned, it's not about just you. It's about the organization. You need help. So when I say here, this isn't just about tools, it's about the culture of the organization. CEOs must foster a culture where the financial accountability is shared. It's not in silos. Encourage cross-functional collaboration with the finance, make your CFO controller a strategic partner, not just a gatekeeper. I know a lot of organizations get hesitant about sharing financial information with their teams. I would disagree with that approach. Now, you don't share confidential information. So take that off the table, put it to the side. But the team should know how the organization's doing. The team should know, here's our sales. The team should know, how do we grow? What is our strengths? What's our core service and business we deliver? How much does it cost to deliver that service? Where are our customers at all in the US or the domestic, where they at? So international, where they at? So I believe the more information is power. The more information you can share with your team, the better. And maybe it's just your leadership team and then maybe the manager level down below. It's all about your organization, who you trust, who's right there. But it's all about incorporating others to do it and working together. And then you get up to the top there, talk about is force yourself. It's not always second nature. It's second nature to CFOs, but force yourself to ingrain this thought into your mindset. How are we going to pay for these things? In the end, again, profit, when it's all said and done, you're going to be profitable if you price it correctly and then control the cost. But there's this period of time when you may have to pay money out the door on the front end, but you won't collect that cash for a period of time after the fact. So always ask yourself, how will we pay for it? Hopefully it won't be an issue, but it's always a question worth asking. And then ask others. You don't have to have all the answers. That's the thing. It's a team, it's a group, it's a culture you're building in your organization. How will we pay for it? Ask your controller, If your head of operation comes to you and says, I want to buy this new $400,000 piece of equipment, great. Your answer is, or your question is, I love it. I love the idea. I love the initiative. One of the questions is, how are we going to pay for it? I don't have 400,000 just sitting on top of the table right now. How are we going to pay for it? How are we going to get the return on that investment? Ask them, have them start thinking along these same lines. Promote financial accountability throughout the organization. Everyone should have like individual budgets. Everyone should have individual goals and targets they work on, and then empower your controllers as a strategic partner. I believe your CFO should be, the term I always use is, a trusted advisor. If you don't have a CFO in your organization today, you just have a controller, then I would say pull your controller in and start seeing if they can become that trusted advisor for you by start giving them little tidbits of stuff to do. And you're going to see that in a second here. And you'll see my question there is, have you included your controller in your strategic discussions or leadership team? Chairs sliding here. And the bottom, success is not about wins and losses. It's about helping these fellows become better versions of themselves. Your goal as a CEO is not just about money. It's not just about the organization. A CEO is one that's supposed to grow the company, grow the individuals within it. As I said before, the locker room's full of potential. Your job is to help them become better versions of themselves. And in this context, we're talking about them become better versions by understanding more of a financial role they have in the company and the organization. So help them grow just like you're going to be growing yourself. So as we get to conclusion, being a CEO requires more than just business development and operations and sales and stuff, but having a strong understanding of financial concepts and then partnering with your controller and your CFO on initiatives and business decisions. If you partner together and you get this financial literacy and financial discipline, then true, you're going to have more and improve your probability of success within the organization and create that long-term value creation that truly is a component of the CFO's responsibility. You start with financial literacy. Look at the financials first thing. So to me, tomorrow morning, spend 15 minutes. It doesn't need to be 3 hours. Spend 15 minutes. Just grab the balance sheet and look at it for 15 minutes. And when you look at it for 15 minutes, ask a question. Ask your controller. Hey, just look at the financial statements. Tell me what accounts receivable means. One is for you, but it's also for the controller. And that's it. Just start taking it, they say eating an elephant one bite at a time. This is the CFO mindset, is one bite at a time. Just start small, start looking at things individually, start looking at your financial statements. Partner with your controller to understand key line items. There's certain line items on a financial statement that are confusing. If you do swaps, that can be confusing. If you have lots of rents, that can be confusing, especially in the ludicrous gap rules we have in today's world. I'm smiling because that's just brain dead. That's brain damage you don't need. But ask your controller, have them explain it. Again, it's information for you, but it's also somewhat testing them. Look at your current initiatives and do a quick ROI on them. If you're in the middle of something, you should be able to ask them pretty quick. All right, we're doing this. If we're hiring a new salesperson or acquiring this equipment, let's just do a quick ROI. Let's just do a little check to make sure we're going down the right path. Ask questions. Why? How? Just keep asking questions. The controller action, this is what I would ask you to challenge your controller. Ask them, how can we increase cash flow? See what they say. How does this impact the future? If we are going to buy this salesperson, what do you think? What do you think this is going to impact the future by, with sales or expense or whatever it may be? Look at your KPI trends. Ask your controller to look at your KPIs and the trends of them, not just as of a point in time. Look at them last month, look at them last quarter, look at them last year, and what's the trend doing? Because once you see a trend, then the question is, okay, if we see it then as a negative trend, then you ask the question, what are we going to do about it? How can we turn this around? So just ask, what if? Mr. Lasso's commentary is, believe in yourself, stay true to doing the right thing, and live life like a goldfish. If you understand Rosh Show, a goldfish basically has the shortest memory of anybody. So I'm not asking you to forget things, but I'm asking you to be brave enough to make a decision and move forward. Not every decision is going to be perfect. Not every decision is going to be right, but don't be afraid to make a decision. Understand what happened with it, whether it was positive or negative, and then move on to the next one. That's what that's about. So I want to just do one last slide as we wrap up to the CEO's challenge here. A little more key, a little more tangible. So this slide you should recognize from earlier on. So the primary focus, what the controller and CFO does. So your action. Invite the controller to strategy discussions. If you're not doing it, invite them. See how they start participating in strategic discussions. Core responsibility. Request them to produce a 3 to 6 month financial and cash flow forecast. One, you need to have it anyway for your organization, but see how the controller or the CFO does. Can they produce a financial forecast or cash flow? And maybe they need some assistance, which is all right, but ask them for it. This is your action to them to see how they can do this. Decision making. Look at your metrics and ask them to create a proposal on one metric on how to improve one of them. See how they approach it. See how they think about, well, if our trend is going down on this one metric, or let's say it's going up, maybe our average cost of benefits is going up on a per head basis, have them come, produce, do a little analysis and come back to you with a proposal. Team leadership. This is something that should be done with the annual plan anyway, but request a 12-month staffing plan. What's your plan and what's the objectives? Everyone wants to grow in their company. Everyone wants to grow in their professional lives. So let's see how the controller / CFO, how do they look at their team? How do they look at their resources, and how can they grow their team to improve their level of understanding and engagement? And then that last thing, engagement piece, invite controllers to meetings and actually have them present information. See if they can present a monthly set of financials to your leadership team, because in that way it's going to show their understanding of the information, the financial statements, and how it applies to the business that you're in. So to say here, challenge yourself or dedicate yourself to improving your financial knowledge by working with the controller and your CFO on these action items. And in the end, you're trying to help them be the best versions of themselves. So that's kind of the takeaway: is ask questions, challenge your controller, challenge yourself by doing both of these items. Start looking at the financials, understanding your key line items, looking at your initiatives, and understanding your KPIs. So thank you. That's the end of the main presentation. And you see down there one of the best quotes that's in the whole Ted Lasso show. That I hope that either all of us or none of us, are judged by the actions of our weakness moments, but rather by the strength we show when and if we're ever given a second chance. To some respects, I consider this somewhat of a second chance for you as a CEO, because you need to drive your business. You're responsible. You've been entrusted with the organization, whether you've created it yourself or you were brought on. You've been entrusted with the organization. So you're giving a chance to grow this, and to grow it the best way possible. You need to look at the entire organization, which includes the financials. Give the financial due diligence, the respect, just like sales, just like operations, just like personnel and human resource. Financial discipline is a key component, and it doesn't have to be the biggest part of your job, but it needs to be a piece you can understand the potential of it. And if you do that, and you do it while also looking at your controller or your CFO, then that way the two of you are basically going hand in hand in the future to take that organization where it can go. So that's what I have. Thank you very much. And I guess I'll open it up to you, Bob, for questions or
Thank
anything
you.
that.
Yes, very good. Thank you, Brad. Very informative, very comprehensive. To best respect everybody's time tonight, we'd like to just take any questions that people submitted offline and answer them to you directly. So thank you again for everybody's attendance. Preferred CFO would like to wish everybody a happy Thanksgiving and upcoming holiday season. Thanks again, Brad, for your time, and we look forward to seeing you in the future.
Great. Thank you very much. Sorry, it took a little longer. Once I get rolling, I roll. So sorry to
Great
leave the time.
information, Brad. Very much appreciated. I took a whole bunch of photos of the slides. I think the slides are available for those that want them. I think there's a Q&A that comes out afterwards where you can opt in for the slide, but I took a whole bunch. So thank you. Very well done, Brad.
Thank you very much.